Hey everyone, this is Dimitri Pragmatic with MarketChameleon.com. In this video, I'm going to demonstrate how you could quickly analyze a particular option's implied volatility by comparing it to the historical volatility. And we're going to use the SPY options chain in this example. I came down here to SPY's options chain and I selected September 22nd expiration. When I did that, the options chain for the September 22nd expiration appeared, and now we have all the data in front of us. And what we want to do is first take a particular option and look at that option's implied volatility. So in SPY, let's just take the at the money strike, and we're going to look at the call. So we could see here there's a bid and an offer in a call. So each option price has its own unique implied volatility. And here we could see that the implied volatility in the bid is 13.9 and the ask is 14.4. So let's just say that this particular option, the midpoint is 14.1, 14.2 implied volatility. And what this is saying is that if we use the option pricing model and converted the price to an implied volatility, this is what the market is implying or forecasting the implied volatility or the volatility of the stock from now to expiration, next 31 days. So that's the average volatility the market is expecting between now and the September 22nd expiration. And the question can be, well, how does that compare to the actual volatility of the stock? If the market's forecast is around 14.2, how does the stock usually trade at? What volatility is that high or low compared to where the stock has been trading? And I'm going to come up here into this box over here, and we have three different metrics to look at for SPY volatility. The first one is showing us the IV30, which is the implied volatility derived from option prices. So what we're more interested in is where the stock volatility has traded in the past. And when we measure the stock volatility, we really have to pick some time frame, over how many days. And here we have two different ways of looking at it. One is looking over a 20-day period. So 20-day moving average historical vol. Another one is taking a longer term 252-day period. So here we see in the last 20 days, SPY has traded at a 10.8 volatility. So if we believe that in the next 31 days, the volatility in SPY will be similar to the most recent history, then this 14.2 seems like it would be high or above that historical vol. What about the 52-week average? That's in the last 20 days, but what if the volatility starts to revert to its longer term average? So if we looked over 52 weeks and looked at all the 20-day historical vols, the average was 18.1. So if we use that as the reversion, then we could see that the implied volatility is too low. If we think it's going to be, if we think that the stock will move more at an 18-point volatility. And then here we get the historical range from 28.9, as high as 28.9 to as low as 8.9. So we could see that the implied volatility at 14.2 is closer to the low range of the year, right? Not at the low, but closer to the low. And if you think that the volatility of the stock will be somewhere between the most recent 20 days and the longer term average, then here we would say it's probably around fair value, right? Between 10.8, 18.1. So then the market kind of is anticipating that future volatility will be somewhere between where we've been recently seen it and between the long-term average. Now we could do the same thing with the 252 days. This is smoothing out the implied volatility over a longer period. We could see that currently the last 252 days was 18.2. The average, the moving average of all the previous observation, so we're 22.2, the high 24.4, low 18.2. So that is a quick way to take a particular option, look at its implied volatility, and compare it to where is the market forecasting relative to how the stock tended to move historically. Hope you guys like this video and hope to see you guys next time. Thanks.